Welcome back for another market update. Looking at earnings, which is the lifeblood of the stock market, we see here Q4 2021, so the quarter ended December 31st, was strong at 31%, but not so fast because that's in the past. Looking at Q1 2022, which is what we're in now, and looking ahead actually into Q2, we see slowing earnings growth, an environment in which the market often declines. We don't like to look too far out into the future with earnings estimates, but through the rest of this year at least, earnings growth may accelerate beyond Q2. As we get some clarity around some of these uncertainties, rising rates, inflation, Ukraine, etc., we hope to see these numbers stay firm. Here's something I've been noticing, at least anecdotally, and it seems to be confirmed here. The blue line here is small businesses raising prices. So it looks like about 60% of small businesses surveyed raised prices. And just about a record low, the yellow line, of small businesses reporting poor sales as the single most important problem. So raising prices and still selling. We're keeping an eye on this one to see how long and how far this goes. But at least in earnings reports, a lot of companies are saying the same thing. And then no surprise here, the yellow line, inflation, making the strongest move as small businesses' single most important problem. But interestingly, still hasn't overtaken quality of labor as the number 1 single most important problem. Used car prices, we've looked at this recently. Here's year-over-year percent change. Obviously super high at 30 and 40% increases. But again, how is CPI measured? Year over year. So we have to look back to a year ago and see where today's prices are compared to that. So if we get flat or even decreasing prices over the next 6 to 12 months as supply chains ease a bit, we could see this line shoot down rather quickly. Consumer credit, going back to the year 2000, we can see the gold line credit limits are up, but the red line balances is off its high. And as a percentage of the limits, that's the blue line, utilization, is quite low compared to the past 20 years. This is fun to look at. It's called the misery index, which is a great marketing name for inflation plus the unemployment rate. This will be interesting to watch as headline inflation likely trends lower over the next few quarters. University of Michigan surveys buying conditions for vehicles in blue and buying conditions for houses in orange. Again, unless some of these home builders and auto manufacturers are brilliantly managing their inventories and backlogs, we may see a glut of homes and cars at some point in the next year or two, which would likely send both of these lines back up to where they've been for decades. And here's a breakdown of household debt by type. So of course, mortgages are the largest, and it looks like student loans are the second highest. Now, when we show debt charts, there's always a bit of uneasiness because often it's rising or at all-time highs. But we have to remember, household net worth has been rising and is also likely at an all-time high. And the debt service, or the burden to make these debt payments, is also quite low. We always have to consider the full picture here. That's it for this week's market update. See you next time.